Hello, everybody. Welcome back to another Watermark Wire. My name is Jack Gabarzik with Watermark Advisors, and today we'll be going through the 3-year rule, how a multiple is built even before the sale begins. So there are 3 essential years in the process to help you get the most premium multiple that your business can sell for. So in year 1, it's all about building the foundation and building the strategy for your business to execute in year 2 when you're building the story that the buyer is going to want to see with your growth and kind of your strategy of where the business will go. And then in year 3, it's all about position and execute. So year 1, building the foundation. And so the foundation really starts with a clear strategy and projections that match this strategy. So buyers are going to pay for these future cash flows, and they're going to see this through a clear strategy. The strategy really has 3 parts to it. One is the vision. It's a long-term kind of vision of where the business would go if you weren't to sell. And secondly, the roadmap. This is more of the year-to-year aspect and what milestones can you hit on your roadmap. And third is the resources that help you act on these. So whether that be human capital, fiscal capital, or technology. And when you pair these with a 5-year projection that reflects your strategy, it builds a lot of buyer confidence and helps you trade for that multiple that every seller wants to see. Then secondly, clean financials. So buyers are going to want to see 3 to 5 years of normalized and GAAP-compliant financials. So a lot of times sellers will bring on a third-party CPA firm to help them build a data book and help them kind of get that Q of E ready financial aspect that won't just help through financial due diligence, but it'll just help the entire transaction run a lot smoother in these building years. Then third is key person risk. So in the first year, this key person risk is kind of really when you develop your management team or you make the right hires or promotions for the people that are going to run the business when the founder is no longer there. And then fourth is an M&A valuation. So what do I mean by an M&A valuation? So this isn't just a pro bono valuation. This reflects future cash flows and also what's happening in the market right now and in the past. So taking into a DCF, so that represents the future cash flows discounted for the business. So that kind of takes on that future aspect. And then the comparables approach really hits on that present and past aspect where you're looking at what transactions have happened in the past that are similar to your business and what multiples those are trading at. And also public comparables with you look at public companies that are similar to yours and what they're trading at right now. So in year 2 is when you build the story and you execute the strategy. So in year 2, you should really be seeing that you're kind of hitting these milestones that you set for yourself on your roadmap. And you should see this in financial, operations, and market milestones. And if you're hitting on all 3 of these in year 2, you're on track and you're in a great place for the selling process. And then financial trajectory. So do you have the revenue growth and margin improvement that are aligned with your strategic milestones? So whether that be switching 20 to 30% of transactional revenue over to contracted recurring revenue that a buyer's not going to have to compete for after the process, and also kind of growing in your market. How much of the addressable market are you kind of serving right now, and how are you going to grow your presence in the market? Then management depth. In year 2, this is when you see that the hires that you made or the promotions that you made in year 1 really start to get increasing responsibilities and accountability with real P&L authority. And then fourth is process documentation. So business owners and founders always have the business plan in their head. It's all kind of like that they can run it in their head, but it's important in the process that you get this put down on paper so that way when the founder and owner isn't there after the sale, that the business can still run the way it is today. Then year 3, positioning and executing. So this is what the first 2 years build up to. Now you can hire on your M&A advisor that's going to best prepare your company for the market. And this is key for a smooth and easy transaction process. And then secondly is the sell side Q of E or quality of earnings. So a lot of times sellers will bring on a third party sell side quality of earnings to validate the EBITDA. And it's really kind of a third party stamp on the EBITDA that also does surface adjustments before the buy side due diligence comes in. And we're seeing that almost in every deal nowadays, that there's always going to be a buy side quality of earnings. So having that third party sell side QV It's not just going to help the financial due diligence go smoother, it's also going to increase your valuation. Then third is the competitive M&A process. So if you just have one buyer at the table, you're really not going to get a competitive process. So it's important with your M&A advisor that they're going out to the right buyers. And so whether that be an alternative acquirer like a search fund or an independent sponsor, or if it's traditional private equity or a strategic buyer, making sure that your business is getting in front of the right buyers to drive in multiple IOIs that lead to multiple LOIs, kind of drawing in that competitive process that you see increasing these premium multiples. Then fourth is internal diligence. So ensuring that you're finding each issue before the buyer does. Because when the buyer finds an issue before the seller, they're going to factor that into the multiple, and it'll end up driving down your sell price. So going deeper into internal diligence, there's really three kind of main categories of diligence. So the first being classic with valuation, financial, tax, and legal. And then there's business due diligence. So that's going to be like commercial and operational due diligence, HR, IT, intellectual property, those kind of things. And third is risk due diligence. So that's going to be the environmental and health, compliance and integrity, and the risk and insurance due diligence. And it's also important to remember that this is going to be a lot on the seller all at once. And so during exclusivity, something called eye of the storm occurs, and that's when the owner is juggling, doing the due diligence, negotiating the purchase agreement, and maintaining the business performance to a high standard while also having to keep the sale process on the down low. So all of that can be overwhelming for the buyer. So it's essential that you get this due diligence process knocked out earlier, whether that be through preliminary due diligence, but making sure that this can kind of be an easier aspect in that eye of the storm time. And so going back to the QofE advantage, so we're seeing right now that businesses that aren't doing a third-party sales side QofE trading more around a 7.0x EBITDA multiple, whereas businesses that are getting these third-party QofEs are trading around a 7.4x multiple. And even for a company that has a $1 million EBITDA, that's a $400,000 difference in your valuation. So not only does it make the financial due diligence easier, it also increases your valuation. And so the bottom line is that there is a version where you win and one when you don't. So if you just call an advisor when you're ready and you kind of hope that the market is nice on your business and you get the result that you want, it's really kind of oftentimes going to lead to a disappointing result. Whereas the businesses that are spending 3 years building something that a buyer can't walk away from, those businesses have a history of trading at those premium multiples compared to the businesses that kind of just jump into the process. So Watermark Advisors would love to help walk you through each one of these years. So from building the foundation to helping you build the story and obviously positioning and executing, each one of these years is essential and oftentimes can be overlooked. The entire 3-year process seems like it's too long and too diligent, but it is proven, and the businesses that really do follow this kind of timeline are trading at those premium multiples. So if you're thinking about selling, the work starts now, and we at Watermark Advisors would love to help you. So please contact us at watermarkadvisors.com if you're ready to sell. But anyways, thank you so much for watching the video, and we'll see you in the next wire.